the rule of law, the ability to, no matter who you are and where you're from, to make a lot of money. It's immigration. I mean, you look at the CEOs of all of these great companies. They don't look like you and me, Bob. They don't talk like us either. They speak better English, but they don't. That's not their first language. That's really, those are the three things that are the secret of our success. Capitalism works, and our version of it, where we've had the steady inflow of people that want to be, that want to make it, become entrepreneurs, make a lot of money. We've been sucking the world dry of those people for the past 200 years.
Growth equities, the top growth equities, are a really good place to be putting your savings if things start going wrong in our economy, and particularly in the debt and deficit area.
Not just because there's growth, but also because, as I said, they're the strongest institutions around.
Rob Rohn, welcome. I'm so glad to have you on today. We have several things that I would love to talk to you about. Rob has been a money manager for his whole life, and he started his own firm with some partners. And so I'd love to learn about the process of going out on your own. And then some of the insights into the money management world. What is it that makes someone good at picking stocks and building a portfolio to compete in the world of other portfolio managers who are trying to generate returns for their clients? Also, what the insights are that you've gathered over time for what the best companies in the country do to boost our economy. Our economy is the envy of the world, and a lot of that is driven by the companies that you've invested in. And we'll get to some of the specialty that you have in the equity management world. And then also love to talk about why has the stock market been doing so well when we're confronted with so many major challenges, and what lies ahead in your opinion overall. And so why don't we start with your journey as an entrepreneur? What were you doing beforehand, and how did it lead you to starting your own company?
I didn't start out as an entrepreneur. I don't. Maybe some people do actually, but and maybe the real entrepreneurs do. I don't really think of myself as an entrepreneur. I'm a cranky old analyst that has managed money for the past 25 years. And did not start out as an entrepreneur. I started out at the other end of the spectrum, going to work for J.P. Morgan out of college. Probably, a hard job to get, but also one of the safest jobs in the world, and not very entrepreneurial. And therein lies the interest in being an analyst, and therein lies the interest in being an entrepreneur. And I give people counsel that going to work at a big organization is a good place to start, even if you're an entrepreneur, because you can see how to do things and how not to do things. And if it's a good organization that you admire, you know how to do things right. J.P. Morgan at the time was, their mantra was, do a first-class business with first-class people in a first-class way, or something like that. You probably know better than I do.
I think I was at Morgan Stanley, and I think we both took that same mantra from
right.
the original J.P. Morgan before the firms were split.
From Junius P. Anyway, so as an analyst, we were working on a mainframe, and it was a mainframe that all led to one line, and that was free cash flow available to you, the lender. And over the course of my career, that has been the most important thing of all. And all the analytical work you do is how much free cash flow is there available to you as a owner of the business, right? After all, going through all the financial statements. So that was an important lesson as an analyst. And the second thing was, I'll never forget, I was assigned to following companies with a team in Middle America, companies like Ford and Stroh's Brewery, you probably don't remember them, and Masco Corporation, the largest manufacturer of faucets. I don't know whether they still exist actually, but at the time, Masco was spinning off businesses into leveraged buyouts, and they realized, this cool game of spinning off businesses, leveraging them way up, keeping a sliver of the equity. And, I realized once when I was sitting around a table with them that it was kind of, heads you win, tails we lose. They have this sliver of equity, which could go up, but it's just a sliver, it could go away. On the other hand, we had all the debt, and, that could really hurt you if it went away. Realized, well, I'd rather be on the other side of the table, and thus went into equity and eventually became an entrepreneur. Advice for entrepreneurs, it's funny, I just hung up the phone with my oldest daughter who's becoming an entrepreneur after 8 years at Google. So started with a good organization and then
Congrats.
going off on her own. Yeah. And she's, we're talking about all the things and that she should be thinking about. She's more interested in the sort of, she's asking me questions about setting up an LLC, and my answer is I have no idea because someone else did that. What you really need to do is make sure you understand, figure out the business plan and make sure you're committed to it. And she is, and make sure it's what you want to do and make sure you got good partners. And I think that's the advice I'd give. You spend a lot of time up front, just as you would as an investor in a company. Spend a lot of time up front. Make sure you understand your business plan, the opportunity. Make sure you understand your partners because you got to trust them implicitly. You're going to go to war with them, and so to speak. Things aren't always going to go well.
Do you connect with your partners?
So I'd worked overlap with them in business. So after I went to business, after JP Morgan, I went to business school, and then I went to a small firm called Yeager, and Marshall, and it was sort of a little boutique asset management firm that did some early stage investing, almost late stage venture capital, as well as growth investing. And actually, the chief operating guy there was Gordon Marchand, who became my business partner. Later on at Yeager, and Marshall, I met George Fraze. I actually had overlapped with him when I was at WP Stewart, interviewed him, so we got
Oh,
to know
so
each other
that
before.
I didn't realize that was where you met George.
Yeah,
George was at one of my clients, and so I got to know him very well too. And so you had met before he went
yeah.
to Chancellor.
And honestly, I went to. Do you know who Dr. Leibowitz was? He passed away sadly during COVID. General GP doctor who was one of these great doctors that looks at the whole human when they walk in the door, and looks at your blood, but also asks you what's going on in your head. And he wanted to interview my business partners before. I mean, so that's the kind of vetting you want to go through. You have all your friends and family meet people and make sure you implicitly trust your partners. And partners are helpful because it's a big load to be an entrepreneur all by yourself.
Yep.
Um, we often joke that the three of us together make one good entrepreneur, or made one good entrepreneur.
That's a good way of
I
looking
think
at
it
it.
is true, and I think it's true. And then the last point I'd make is that once you make that commitment, then you burn the boats. You're committed. At some point, what's going to hit the fan and it's going to blow all over the place, and you got to keep your head and you got to stay focused and you got to keep going. You can't run away.
So, and tell me about the launch. What was it a good time to be raising money?
It was kind of, if you think about 2002, it was a recession period, and the markets were still recovering from the tech wreck. Both of our organizations had been relatively savvy. It didn't feel like it at the time. It felt like idiots selling technology holdings in 1998 and 1999, but we did. At WP Stewart, I remember clearly making a speech in front of 700 clients and explaining why we sold Cisco to buy Cisco, Cisco Systems to buy Cisco, the food service distribution company, based on valuation. And I felt for my physical safety at the time. This was late 1998, I think it was, and Cisco Systems continued to go on to be I think it was at the time, the largest market cap. And
Yes, and most expensive. It was a time that was not dissimilar from today. There were a
yeah,
handful of super winners. They were the largest companies going up the
right.
most with the largest market cap.
So I think with our style of being careful of investing in companies that have certain characteristics that make them predictable, and then doing our homework, and then being careful about the valuation resonated at that point in time. Wood and Marshall came through that period well too. So our anchor client had been a Yeager, Wood and Marshall client, and so for our particular style, it was a good time to launch. Yes.
How did you describe the style at the time, and has it migrated at all?
Yeah, and I think that this is also a lesson for entrepreneurs starting a business. What often happens in our business is people name the business after themselves, um, which is a tempting thing to do, right? To put your name out there and create a legacy, but it doesn't necessarily lead to an ongoing franchise, right? Because you have to think at the very start of building your organization to succession. If you're not thinking about it at the start, you're not going to do a good job with succession when you need to make that move. We chose not to name the firm after ourselves. We named it after our quarry, so to speak, and the approach, which is look for what we call sustainable growth companies. And of course, that word's become so heavy with meaning. It wasn't really about any ESG stuff, except good governance and being responsible. Um,
Yeah, it's pretty funny. The definition has migrated over time, but
yes, it has,
the
but it was really
concept
about
was,
companies that can sustain their growth over 5, 10 years or longer. Because we really wanted the only the best valuation tool you can use is taking that, remember that cash flow available to shareholders, which I talked about. That's the big number you want to get to when you do all your analytical work on a company. And you want to apply a valuation tool to that. And what's the best valuation tool? Counted cash flow. And you can't really do that with companies that you can't predict out 5 or 10 years. Doesn't, and even with companies that are highly predictable, out 5 to 10 years, things get pretty murky, but you can get close. So that's the approach. Choose companies that you can predict because of certain characteristics. You can model them, and if you can model them, you can value them.
what was the benchmark that you set at the time? And it was a concentrated portfolio approach,
Yeah,
wasn't
it's
it?
it's
So it was,
concentrated at 30 to 35 companies, and our view is that you get, and if you go back to your textbooks, the benefits of a diversified equity portfolio start to roll over a little bit. That at 20 holdings or so, and 25, the incremental benefit from another holding gets lower and lower. And we didn't want to get to the point where you're just adding names because you're indecisive. That's diversification, as someone put it. So
yep,
30 to
or
35
hedging.
is,
You're
yeah,
basically hedging,
yeah.
it dilutes your work
So we thought
because
30
you're,
to 35 was pretty concentrated. Today the index is a lot more concentrated than that, at least in the top 10 holdings, um, or even in the top 30 holdings. So that's the approach that we chose, a pretty, concentrated portfolio.
and then there
Um,
was an element of growth at a reasonable price as well, where you had a valuation overlay after
yeah,
saying, we're going to concentrate on those companies that can grow sustainably over the long run, define something like 10 years, right?
yeah.
And then
So
we're going to be careful about valuation.
basically it's 3 steps, and most of the stuff I've learned over the course of my career, I've had to unlearn actually. I mean, and just take things back, simplify, simplify, simplify. The other analysts here make fun of me because, they have 15-page models with 200 lines, and I've taken all my models down to 1 page and, less than 50 lines. Because if you try and find the circular reference otherwise. You want to focus on what's important and you want to keep it simple. And within our approach, there are really just 3 steps. Number one, perform triage on the world. Only invest in those companies that you like, that have the predictability that makes them sustainable, and have secular growth drivers behind them. So they've got sustainable growth. Second step is do your homework. It's not that hard. Build a model, talk to the company on a regular basis, keep keep tweaking those models and understanding what the future is. And when their business changes to the extent you go back to the original thesis and it's not recognizable, then you move on. And that's important. So you do your research and you test the thesis on a daily basis. And then the last step is you got to earn your discount rate. In a DCF, there has to be, if you don't think you can make money, you can't count on a greater fool theory. You gotta be able to make money for your clients, or else you gotta call them up and say, I can't make money for you.
So that sounds pretty straightforward, and it's a highly defined strategy relative to a lot of the clients that I had over the years in the equity business. When you describe it that way, it looks like the perfect description for what a great stock market we've had over,
Yeah.
you know,
Hmm.
this has been a concentrated growth environment where the
Yeah.
good large growing companies have become a disproportionate part of the benchmark performance, which ironically is a headwind for you all, isn't it? Because the concentrations that the biggest companies that are performing the best are higher than what you're comfortable doing. And so you are essentially actively short those larger, great performing companies, aren't you?
Yeah, and it's really odd for us too because we build one superset portfolio and then we choose based on what our clients do with their asset allocation. So some want, a U.S. domestic approach portfolio, some want a global approach, some want an international portfolio, which is, everything but the U.S. We try not to get too distracted by that. We build one superset, and yeah, 6 of the 7, the Mag 7, are on that qualified company list. And then we put them in portfolios of, 30 to 35 names, and that gets you to, even if you're overweight, a 5 or 6% position. And we decide we're going to underweight, average weight, or overweight within the portfolio. So that's anywhere from 2 to, 7% position. So even if you like Amazon, and it goes up like it did last night, you're only going to own half the benchmark weight. And you walk into one meeting and they say, why don't you like Amazon? And then you walk into a global meeting where it's less, it's much less. It's about half of our weight in the index. And they say, gosh, you love Amazon. That's great. So, it's so confusing. And that's why we, from the start, and I didn't answer a previous question about what our benchmark is. We can't control the benchmark. So it doesn't play any role in our process. Right? There's nothing we can do about the benchmark.
This show is being brought to you by our sponsor, Trueflation. Professional investors and economists, and probably any casual observers, know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $34 trillion in debt. Trueflation collects over 13 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at trueflation.com.
Shooting for a absolute return, hopefully double digit, hopefully in the mid-teens. A lower than average level of risk, specifically that volatility of earnings and cash flows risk and the valuation risk. And that's what the metrics show us over time is the case. But it's very hard in a period, like the last 3 or 5 years to outperform the indices that are so dominated by, the Amazons.
Yeah, it's so ironic, and this is one of the subtleties that I wanted to explain to our audience is that you can define your business exactly where the sweet spot is, and still trying to put together a portfolio that's going to keep up with a market like this is very, very difficult.
It's hard to outperform, and our clients, we tell our clients right up front, look, we're trying to deliver a double-digit return, something in the mid-teens. That's the earnings and cash flow compounding we build behind the portfolio. If we do our valuation work right, we won't have to fight valuation over time. Markets will swing up and down, but over time you should get that double-digit return. That's what we've delivered over time. They say they understand that, but then you come back in and they're like, well, why are you underperforming the index? We're like, remember we told you. So it's hard for them too. They're coming, they're being asked the question too. And, we've seen, our clients and their asset allocation go, okay, we're going to hire you, but we're going to take some away and we're just going to put it in the end, we're going to hedge out some of this basis risk. And to us, there's risk in the other direction now. It's more likely, if you go back 10 years or you go back 20 years, the big Cisco Systems being a great example, the big weights in the index today are not going to be the big weights in the index 10 years from now. Maybe 1 or 2, maybe 3 will, but certainly not all.
Yes, we've seen that. For better or worse, we've been around enough years to watch how the market composition shifts and changes and evolves. And it's hard. I imagine that you probably could even foresee some of this in the market as it was beginning to evolve and as it was more and more evident that there was a concentration of. One question I have is when we get these periods of concentrated performance in large companies, is there something that are the earnings of those companies justifying the multiple expansion, or is there a liquidity issue that's driving these stocks up to higher multiples than what their financial characteristics might entail? Returns on
Yeah,
equity, margin expansion, revenue growth,
I
all of
think it
those
really,
components.
yeah,
Are these periods where the multiples are going up, or are they actually generating a disproportionate amount of earnings out of the economy?
I think you really have to take them, you have to look at each one of them individually because there are different things going on in each one of them. But if you take the biggest one, or what was the biggest one, I don't think it's the biggest way anymore, Apple. I think, there was a liquidity push. Their revenues and earnings didn't grow for about a 5-year period, and yet, but the valuation roughly doubled. I think a lot of that was liquidity. Maybe it was some fundamental recognition of their service business, but the service business is still what, 25, 30%. It's not, and is likely to shrink with this Google antitrust suit. So, yeah, so maybe it's the case with Apple. On the other hand, Nvidia, the earnings have been pushing that stock up. They're sold out for 3 years and everybody wants their product. And yeah,
Well,
the
that may
multiples
have
come
been.
down over the last 2 years.
Yeah, I would think that might be one of the most painful stocks for you right now because it caught on. It was, you could anticipate that the earnings were going to grow. You could see all the forces, but it
Yeah,
was too big and growing too fast and too big a concentration for you to be able to keep up with it, I assume.
yeah. And not only that, but it's hard for us. It's a cyclical business. Just look
Oh, it
over
sure is, yeah.
you just have to look over history, and it will remain a cyclical business. There's a window of time here when it's not because pretty much, they've got 80% market share. That won't be the case 5 years from now, but they have 80% market share, and there will be a cycle again. So it's not just so much that it's growing so fast and the weight is so high in the index, but we know that there'll be an air pocket out there, and we have to factor that into this 10-year discounting mechanism. And so we have to sometimes prune the flowers and water the weeds.
In a portfolio of 30, 35 stocks, how often do companies fall out or come in on average, since you launched the firm?
Yeah, this is partly intentional. So we've built into our process about 20% turnover in that superset, our qualified company list. And that
Oh, so
leads
you kind
to,
of force rank them. The bottom ones may be sustainable, they may be cheap, but they're not as good as the other ones, and we're going to hunt for a
yeah,
new name.
it's almost a Foster Friess pig at the trough thing. I don't know whether you've ever heard him talk about, you want the hungriest pigs at the trough, and they push out the weaker ones. It's kind of the way we do it. So the superset turns over 20% a year or so based on new name generation. You have to make sure you have a new name generation engine within your process. That's one way we ensure that that happens is we want to get, somewhere around 20% turnover. And that leads to something like that in the portfolios as you choose the best from the qualified company list based on quality, based on growth, and based on current valuation.
Is there a market cap minimum? Does a company have to have been successful for a certain amount of
No,
time or gotten to a certain level of
there are
valuation
very
for you
few
for it to
hard
be
rules in
candidate?
our process. We apply judgment. As a company have the quality we seek and the characteristics we seek, and that we haven't really talked about that, but this is based on a lot of scar tissue. You narrow down what you look for to just a handful of things. Finding those characteristics sounds simple, but it's not easy. Things like pricing power, recurring revenues, so that you can actually visibly see what's going to, half of the revenues are visible 3 years out or something like that. Secular growth we talked about, not driven by a cycle, or not driven by what's going on in any government or any economic region. Good management you trust to execute, and good cash flow characteristics, because that's ultimately what you value things on. Yeah.
Only because Nvidia is such a topic these days, and it had the unusual characteristic of being around for decades before it actually took off. Had
Yeah.
Nvidia ever made your list before the AI boom started, this extraordinary demand for its chips?
Okay, so I'll tell you an old cranky analyst story. About 30 years ago, I was following Microsoft. I was at their annual meeting in June, their annual analyst meeting in June. I think someone like Greg Maffei. Do you remember Greg Maffei? Do you know him from Dartmouth?
Yep.
I think he was the
He was
CFO or someone like
he
that.
was a class behind me at school.
Yeah, CFO. He was the CFO at the time. We're meeting out in, and they always did their analyst meeting in June because they repriced their options at June 30th, and they would talk down expectations so the stock would come down. I mean, it was a ridiculous game. Anyway, and you get some
Wait,
FaceTime,
say it ain't so.
right? And you get some FaceTime with Bill Gates, and I was sitting around a table. Maybe there's 15 people at the table, and Bill Gates is doing his thing. He's doing this at the table, not making eye contact with anyone. Everyone's asking him questions, and someone asked him, what are some of what other companies do you think we ought to watch? And he said, you should watch Nvidia because I think that the architecture of GPUs is going to have a lot more applications than just gaming. And of course, that one just went over everybody's head, including mine. And now
What year was this?
very good.
This was a long time ago, I'll bet.
I bet it's 30 years ago,
Yeah.
maybe 25 or 7 years ago,
Yeah.
mid to late 90s.
Yeah.
Anyway,
When I was at Morgan Stanley, we brought them public, and
yeah,
it was a gaming chip, and it was phenomenal. The company did really well, but it marked time. It went through cycles and up and down, and it never really became a gigantic company for
yeah.
many, many,
Sometimes I
many
feel as an
years.
old cranky analyst, you have these Forrest Gump moments. You're sort of at you're wandering through your career, and you happen to be at this pivotal point in time. And that was a pivotal point. He recognized it, and the world hadn't yet recognized it. They knew it, and they started building out their kind of vertical systems to deliver.
Xbox.
Yeah.
Yeah.
Well, not well. Xbox was a little. They understood it through Xbox perhaps, but Nvidia for the past 2 decades has realized that their systems have broader applications than just gaming and graphical purposes, and they've been building out a stack, both software and hardware and systems to deliver on that. And unfortunately, the first couple of applications were things that we couldn't really sink our teeth in and find visibility into, right? We couldn't
Or
project them
big
out.
enduring markets, right? Because
Yeah,
in the beginning, it was fitting weird
right. I mean, gaming and
specialty.
Bitcoin mining were not things that you could sort of predict. 3 years ago, one of our smart analysts who was a master's in computer science and said, it's now becoming visible because they're selling into data centers. It's becoming, a big chunk of their business. And that's visible because of, a very small percentage of data center CPUs or GPUs, and eventually that's going to migrate up over time. So we could start getting the visibility. So about 3 years ago, we added it to our QCL, and we thought it was too expensive. And then when they had that blowout quarter, was maybe the first quarter of 2022, when their earnings kind of like tripled, and everybody was like, "What?" And the stock went up a lot, but suddenly our numbers changed a lot too, more so than and that's really what's been happening with Nvidia. The earnings have gone up just algorithmically, and people have been trying to keep up. But it was about 3 years ago, to answer your question, that we figured out there's visibility here, and they've been working on this stuff for 2 decades. They have a big lead, and so it was before AI sort of became a big, the driver of the stock
And market, yeah.
and market cap.
ChatGPT
But
wasn't out yet.
yeah, we've owned it for about 2 years, but in a much
Well,
smaller weight than the index.
that's probably an excellent segue into this idea of U.S. corporate excellence. Big report out of the European Union by former central bank head Draghi, analyzing the future of the European economy and kind of raising concern and pitching a new plan so that Europe can begin to innovate again because it's been stalling out. And you look at what the American economy has been able to produce, especially through the companies that you've been studying. What are how much confidence do you have in our system to continue to generate companies like this? And what were some of the characteristics that allowed our country to produce companies like this?
Yeah, I mean, it's the rule of law, the ability to, no matter who you are and where you're from, to make a lot of money. It's immigration. I mean, you look at the CEOs of all of these great companies. They don't look like you and me, Bob. They don't talk like us either. They speak better English, but they speak better English, but they don't. That's not their first language. That's really, those are the three things that are the secret of our success. Capitalism works, and our version of it, where we've had the steady inflow of people that want to be, that want to make it, become entrepreneurs, make a lot of money. We've been sucking the world dry of those people for the past 200 years. So, immigration's a good thing. It probably should be controlled. I mean, you think back to, you probably did that class trip to Ellis Island and how every single one of those people were processed and we understood who they are. And there's a record of every single one of them versus the total chaos that exists
And you,
today.
you didn't want to arrive with a fever.
Yeah, right, exactly. So, we got to manage it, but that's the secret of our success.
So I guess what's attracting that would also be our university system, our relatively low shackles on corporate America and corporate activity.
Yeah.
Is that right? I mean, have you spent much time looking at foreign equities as well, or is it just U.S.?
We try and again try to really strip out all the complexity and just think about the world as our oyster. And you have to think about the country of domicile and the rule of law and the level of profit motive. And certainly these are all questions that come up with respect to China over the last couple of years, which is a big 20% of global GDP. It's that raises a lot of interesting questions, which I know you've probably been asking. But you want to, I think you want to start out with just, yeah, I don't care where the headquarters is. I mean, look at a company like Mercado Libre. I don't know if you're familiar with Mercado Libre, but
I am, yes.
yeah. So based in Argentina, would you ever invest in a company based in Argentina? Probably not. If that's the way, if that was part of your screen to begin with. Sort of like, I don't care where the headquarters is. Where's the business and what are the risks? And, that allowed us to ride that one for a long time, the last 10 years or whatever it's been, 5 or 7 years.
One of
And
the
now
best performing stocks in the world, right?
I don't know for sure, but it's been a good one. Yeah.
Yeah, it's been huge.
Yeah. And, would you expect that out of a company that has its domicile in Argentina? No. Now, I think now the official country of domicile is Uruguay. Okay. It's not going to make it through a lot of people's screens either. But, a lot of their businesses in Argentina where high inflation mean their costs are, that when you have your headquarters there and you have a lot of your costs there, that's actually a good thing. And a lot of their business has been in Brazil, which has been a GDP per capita story over the last 10, 20. It's stalled out over the last 5 years or so, but and Mexico is next, and e-commerce penetration is a lot lower there than it is here or any place in Asia.
Are there other contributing factors to what makes America the home of so many breakout technological companies?
The apparent safety, obviously, both geopolitically, financially, the strength of the dollar. That's a
And the rule
headwind.
of law. I assume
Yes.
the rule of law plays a good part.
I think that's number one. Yeah, rule of
Yeah.
law and the profit motive, capital, the ability to make a lot of money. There's a lot of examples of people that, walked across the border and you mentioned education. That's important, but I don't think it's the most important thing. Motivated people figure out how to learn and they
Yeah.
figure out they don't necessarily have to go to an Ivy League college and they
No,
figure
but
out,
I imagine that our university system is drawing international talent, much like our our economy is.
yeah,
And
but
that,
they'll
that was
leave
more,
if they don't.
it was less, it's more the magnet effect than it is the education effect that I was
Yeah,
thinking
I
about.
agree with that, but they'll leave if they don't think that, there's rule of law, if they don't think this is a stable um,
Yeah, totally agree.
democracy, and if they
And
don't,
actually, that all of that probably plays into people coming to our university system, the magnet effect as well.
yeah.
So, in the last 4 years under the Biden administration, we've had a change in philosophy of antitrust. What it's taken for our country to get to where it is this a threat to continued dominance, or is it an appropriate reaction to abuses?
I think some of it's probably appropriate, but the problem is that, the government's always, I would say, 3 to 5 years behind reality. Maybe that's just the lead time of any legal action. If you followed the Microsoft case as I did as an analyst 25 years ago, the government spent a lot of time, chasing down Microsoft on an issue and really didn't have an impact on the company or their abuse of monopoly power. And I'm so glad I never got subpoenaed because I was in the room with management who said we're gonna cut off Netscape's air supply. That was the goal. And they did it by bundling, the browser. According to the law, and I'm no lawyer, but you can be a monopoly, but you can't abuse that power, and they abuse that power with bundling. But that's not what slowed them down during the decade, from 2000 to 2010. That what slowed them down was, the lack of innovation and elsewhere.
Yeah, poor management.
In management, and Steve
Yeah.
Ballmer jumping down up and down on the stage, but not necessarily getting people to work together.
And
Um,
making a lot of very interesting, in quotes, acquisitions,
yeah,
using corporate
yeah,
capital in a very strange way.
trying to make even more interesting ones probably that would have damaged them further. But in any case,
Yeah.
so I don't think antitrust is effective. It's a waste of time, waste of taxpayers' money. And here we are, by the way, 20 years later, and Microsoft bundles Teams, sells it to my organization, and tells us that we can't use Zoom anymore during COVID because we've bundled Teams for free, doing exactly what they did 20 years ago, and no antitrust. And Lena Khan's so interested in going after Amazon, which has been sort of kind of an emotional obsession of hers for a long time, that no one even notices. I mean, why aren't they going after Microsoft? There's got to be a warehouse full of documents that justifies the government, which would show that Microsoft is in violation of the consent decree, which is now expired, but still. So it also, there's no follow through between administration, so it's pretty ineffective, and it'll
Yeah.
be ineffective in the case of Google. What's going to get Google is not antitrust. It's going to
It's
be
probably the best example, the easiest thing to look at today and say
right.
that
Chat
artificial
GPT
intelligence.
search is going to get Google, not the government. Yeah.
Exactly right. It's so obvious that artificial intelligence applications really make search a highly questionable, effective tool in the future. And yeah, I think that's a great example. So, and by the time they went through all the court battles and all the time, even if they might have been right before AI,
Hmm.
by the time it all would have happened, it's not going to be what takes Google down. And most of these companies, I mean, there's no such thing as a company that lasts forever.
Yeah.
And it's usually not the government that's the one that's taking it apart.
So
So
that's not
how
good use
about
of our taxpayers' money, in my view. I think policing some egregious cases, boy, I'd love for them to go after some of the telecommunications and cable companies, because those, I think that they're really abusive, and people don't know what they're getting charged, and they're probably being overcharged. And for God's sakes, Google gives away its services free. Let's go after people that are hurting people's pocketbooks.
Yeah,
Yeah.
I've always thought that too. Same thing with Facebook. It's you're delivering to a customer for free a whole lot of very interesting things, and you're selling advertising largely through an auction. So it's very hard to force a price problem. All I have to show is that it's
Yeah.
an auction.
Yeah.
So it's hard to. It doesn't really fit the old definition of a monopoly where customers are harmed by pricing collusion or monopolistic pricing behavior.
It reminds me a
That
little bit, and just maybe answers your question about, what company do you really, what's a good example of a great company? Probably the greatest company, and, it's a low tech company. The greatest company I've ever observed was Walmart during their period of growth. And everyone bitched and moaned about how they put, neighborhood stores out of business, and they did. But, eventually good merchants figured out how to compete around them. But they have delivered, and Amazon's doing it today. They're delivering goods at a price that allows people to live better. That's their tagline, I think. They have employed millions and millions of people. They've made a lot of people rich. through, pretty deep shareholdings within that employee base. Sam Walton, did more good for more people than any politician in this country had ever has, in my view. So, I mean, you know, there's an example of a company that's done a lot of good. We'll bitch and moan about how they gutted, downtown areas, but they're coming back, and maybe they're better off and focusing on service or focusing on niches where big purchasing power can't reach them.
Well, I'm sure that you share my feeling that the stock market over time does a phenomenally good job of identifying value in companies that are providing value, and they're extracting an economic rent and delivering a profit to the shareholders, because what they're doing is really something the customers are voluntarily seeking and willing to turn over their money.
Yeah.
And that really is the mark of what's made our economy so strong over a long period of time. The stock market's a very good measure of that, in my opinion. I'm sure you basically have a business based on it, I assume.
Yeah, I mean, yeah, we do actually, and part of we don't add that much value actually, in my view, as a firm. I mean, I don't think our industry adds that much value to be honest. We just almost, the way I honestly view our business is we're almost parasitically attaching ourselves to those businesses that do, and charging our clients for more often than not identifying those companies that really add value. A great example of that would be today, cloud computing and web services. I mean, think how that came to be. Amazon sitting there as an e-commerce retailer realizing, damn, we got all these computers and data centers managing our business, but because our business is so seasonal, we're only using cycles in the fourth quarter during Christmas time, or when there's a lot of traffic. Why don't we rent out some of our capacity in the other three quarters? That's the germ of the idea. Again, a Forrest Gump moment, but I think it was like 2003. We're sitting there. I'm sitting with Henning Kagerman, was the CEO of SAP at the time, and asked him, the analyst question, what other companies are doing interesting things, and he said, "Watch what Amazon's doing in corporate computing." And we're like, "What?" Went right over our heads. Um,
You must be thinking about the wrong company.
yeah,
I know what they
like
do. They sell
that's
books.
yeah. Anyway, so here they are. They built this business so you don't have to have a server in your office. You don't have to have your own server farms. You don't have to run your software. You're basically doing what I don't remember, Scott McNeely of Sun Microsystems and Larry Ellison used to talk about computing as a utility that you rented. I mean, that's basically what they're providing. It's so much more efficient. Um, but that's what great companies do.
Remember the wall of worry that no one really believed that we would turn over our security to a cloud where, who knows who could access it. And then it totally reversed on itself. Like, who better to give it to, because every company's getting hacked all over the place. And those
Right.
guys have so much,
Yeah.
they have their entire business at stake, and
Right.
they are technical people. They'll figure that out and protect it much better than you. All of a sudden, there's a complete reversal where I
Yeah.
want security, so I will go to the cloud.
Yeah. But anyway, that's a great example of a great company figuring out how to really create a lot of value added, a lot of efficiency, better, higher performance computing at a lower cost with more safety. Yeah, with greater safety and security.
Are there any things that you see about today's world that poses a risk to our stock market continuing to do well? And I ask that because over the last couple of years, what this year seems to be a record, close to a record gain for the S&P 500. It's a big year. And
Yeah.
coming into this year, we had the prospects of the beginning of World War III. We have, increased polarization politically. We had increasing storms. We have so many issues that everybody worries so much about, and yet the stock market just keeps going up and up and up. As you look out Are there things that you think fundamentally threaten that, or is our system, is this just a reflection of a system that's in good shape?
Yeah, I don't get it. But again, I preface that with, I'll remember when, oh, I don't get it, when valuations kind of, I think that was around the tech wreck, right?
It was no, it
We,
was the peak of the internet boom, and
it
I
was
had
bigger than internet boom,
one
yeah.
of my value portfolio managers at a very large firm also lost his job. People were losing their jobs all over the place because they just kept saying
Yeah,
the same thing in meetings. This doesn't make any sense.
yeah.
I don't,
So,
I don't get it.
so sometimes people, who've been doing it a long time have
Are
good
missing
judgment.
something about today? Yeah.
Other times though, I think, analysts do get cranky over time. And, I think it's a life cycle thing. Partly we built our firm so we didn't depend on any one person. We've built redundancy into our research. We've built redundancy into our portfolio management. There are three-person portfolio management teams because individuals are fallible and go through different cycles in life. They have a lot of kids and get buried and they get divorced and get depressed. And, there's all kinds of things that can happen. So you don't want to rely on one person. You don't want to rely on me, for instance, because I'm probably old and cranky in my career, but I don't think, it doesn't make sense. We're back at the same level of geopolitical risk that I experienced and you and I experienced as a kid when we had to do duck and cover drills in the base, underneath our desks and do fallout, shelter drills, once every whatever couple of months in our schools. We're we're at unprecedented levels of debt. Now that's been the case for a long period of time. People have been talking about it for a long period of time, but that's the kind of thing where there's a tipping point. There's at some point people lose confidence. And one thing that supported confidence is that the dollar's been a reserve currency. It won't be a reserve currency 10 years from now. Maybe it'll be one of, but it won't be the reserve currency. It just isn't, it won't be. So I don't know where the tipping point is, but it's out there. And it's probably within the next 10 years. And the geopolitical risks are, significant over the next 10 years. And all of those I think, are made a little bit worse by the fact that we're so politically divided. And not just divided. You and I talked about it the other day, but we hate each other. I mean, it's just like, there are irreconcilable differences between people. And they're largely illogical and they're largely driven by, the vitriol in the media. And I love that piece you told me, take back your mind, and don't let them make you hate each other. We all need to take back our minds and take a chill pill and walk away from the dumpster fire, so to speak. I think that was the metaphor in the article. And
Yeah.
the problem with our division is that it makes all of those other problems a whole lot bigger, right? We can't solve the fiscal and debt problem. We can't solve, it makes the geopolitical problem bigger too, because the geopolitical problem largely hinges on the perception of weakness in this country. Xi Jinping has his 9-point boundary that he wants. He wants that territory. So yeah, some of it's Taiwan. We hear about that a lot. Some of it's part of Japan. Some of it's part of the Philippines. We have mutual defense treaties with both of those countries. If he perceives weakness, he's just, he keeps moving, the boundary. And there's a lot of people have written about this. I heard Kevin Rudd speak last week, Prime Minister of Australia. I think he had 2 terms and has done a lot of other things. He's an expert on China, and he calls the next 10 years a very risky period, or something
Yeah,
else.
kind of a test period, right? It's when
Yeah,
China has now begun to
right.
get big enough that they can start challenging us.
But our division, and of course, names are being fanned in social media by their security services, the Chinese, the Russians, everybody else. Just love to see us. The way you defeat the U.S. is not by bombing them, but in a country where there are more guns than people, you turn them against each other. And that's their goal. So this division makes those other issues bigger, the geopolitical issue and the fiscal issue. We can't agree. Everybody wants to hand out goodies, but nobody wants to cut the budget.
Yeah. I think part of the lack of impact on our stock market from geopolitical tensions is that it doesn't, it hasn't in the past risen to the level that impacts our economy. And that on the margin, it has actually helped the economy through increased defense spending. And there is somewhat of a trickle
Yeah,
down in the manufacturing side.
yeah,
And that someday it's in the past one of the other characteristics of today's world is that the global economy is much larger in comparison and more powerful in comparison to governments than it has been in a long time, if ever. And so there's a higher threshold of geopolitical violence that's needed in order to disrupt the economic side. And so it's been a mistake to take action on
hmm
geopolitical tensions rising as a matter of course over the last decade or two. And
yeah,
it's easy to worry that that's going to change in the future. Um,
yeah. So he calls it the decade of living dangerously. I was just looking up the reference.
uh,
But yeah, yeah, I mean there may be good explanations for the market, being as strong as it is, but again, I don't get it. I think the risks, and they're not so much black swans. I mean, they're closer in on the probability curve. Real conflict, real fiscal issues in this country, and real debt
um,
issues in this country and elsewhere in the world too. We're not alone in being living above our means.
it's been very interesting that during this Fed tightening phase, that we really haven't seen things break. We saw Silicon Valley Bank and we saw the Fed take action and smooth that out. And in my investment career, I would have really been surprised. I was
Yeah,
expecting that a 5 percentage point move in the short rates would have caused some very quick
I
and
agree.
strong dislocations that we really haven't seen. And there are some pretty good reasons. And one of the reasons is that the fiscal spending really took off. And that there is deficits, according to many economists, are naturally and necessarily stimulative to the
Yeah,
economy.
yeah,
And when you look at the jobs numbers, there's been a growing portion of new jobs that are actually federal government jobs and state and local government jobs rather than private economy. And I do think that if this continues in its same direction, we're not only going to have a debt deficit dollar problem, but we're also going to have an efficiency problem in the economy. Too much of our capital is being displaced by government, and government it doesn't follow the same priorities and incentives, and I think that can dampen economic resilience.
yeah,
So I
that's
worry
right.
about that.
Well, yeah, part of that is, a whole nother subject is this reversal of globalization is also a reversal of the efficiency curve we've been on in the last 20, 30 years. We're going by definition becoming less efficient. If we insist that Pat Gelsinger build plants in the U.S., even though they're not very good at it, because we need to be self-reliant, we're not going to, trying to wean ourselves off of reliance on Taiwan or China, then we're going to be less efficient, and that's going to push capital, right? It's going to push capital in the wrong directions.
Well, one of the reasons that I'm glad to have had you on today is that, generally speaking, when you run into government problems like this, particularly debt and deficits, and resulting inflation, which is what ought to happen, and currency debasement, which always has happened, that stocks are one of the areas that can hold up very well in times of inflation, but you have to make sure that you're getting the right stocks. Have you spent over the cycles of inflation over our careers? Have you shifted your portfolio according to inflationary times to move into stocks that are better hedges against inflation?
That's built into our process, so we don't. It's not an active effort. If you
It's a
start
pricing
out
power, right?
if you start out looking for pricing power, then you've got an inflation hedge.
Yep.
And so that's what we do. And I think part of the reason for the stock market strength, especially the narrow strength, precisely that reason too. I mean, there's so few places you can find pricing power and secular growth. And, those technology companies have it. And so a lot of money is squeezed in there for that reason. There's, 20 years ago or 30 years ago, when you put together a sustainable growth portfolio, a lot of it was, you know, global consumer products companies, it wasn't all technology, but now none of those companies can grow. The world is just a much more mature place. It's harder to find secular growth. So, the place you find that secular growth and that natural hedge and pricing power is in, a smaller space, and it's called technology. Weight loss drugs, and a few other pockets.
Yeah, exactly. If inflation moves from 0 to 5, then and some companies can actually leverage that, then they're all of a sudden growing faster, and they're going to hit your screens. And
Yeah, and that is the best of all inflation hedges. There's no question about it. Is businesses that can grow, and they're the strongest institutions by far. I mean, I would argue that they're the institutions you can trust going forward, given, the fiscal situation in a lot of places, as long as they're allowed to operate freely under the rule of law and, good incentives. That changed a lot in China in the span of a couple of years. That they're probably the institutions you can trust most, more so than Bitcoin.
nope, you can't trust anything more than Bitcoin. Bitcoin is completely trustworthy. Um, well, this has been fantastic, Rob. Thank you very much. I think we've covered a lot of topics really well.
Yeah, good. If I had to
Really
summarize, because
appreciate
I
it.
was actually thinking how I would summarize, the view of the world these days, it's, we've gone from glory days to scary days. So, you want to be careful.
I think, yeah, I do think though that also that phrase fits many of the years that go back to 1950, right?
True. I
Because
mean,
there's
certainly
always been
the 60s and
there's
70s were scary days, no question about it.
exactly and absolutely, and with nuclear war, that was really scary. I mean, we don't really have that anymore, and we got a lot of things that scare us about it. I'm not saying that we're,
Hmm.
but there, those are some of the timeless ideas. But there are plenty of ideas right now that are not so timeless. That we do have. I think there are greater strains in our system right now, and that's what I'm going to be spending time interviewing people about.
Yeah, yeah.
But I'm glad that you came on. I do think that it's important for people to understand that growth equities, the top growth equities, are a really good place to be putting your savings if things start going wrong in the large, in our economy, and particularly in the debt and deficit area.
Not just because there's growth, but also because, as I said, they're the strongest institutions around in
Yep.
a lot of
Yep.
cases. So,
Well, great. Well, Rob, thank you very much. Have a
you
great
bet.
weekend.
Thank you. I'm honored to have been a part of this.
Hey, if you like this clip, please hit the subscribe button. You might also want to check out some of the clips I posted with my many other guests. My interviews all address the simple question, how screwed are we? We ask experts about the problems that make Americans so pessimistic today, but we also explore why there's never been a better time to have been born than today. Join us for perspective on today's challenges and opportunities.